Now here we are going to discuss about capital asset pricing model. Definitely 7 marks short notes will be asked, otherwise problems will be asked for the examination for 7 marks. So now here we are going to discuss about the Sharpe model or CAPM. Mahavir's model already we have discussed in the last chapter. Now here we are going to discuss about the here what is exactly CAPM. CAPM is what actually, and CAPM again we can say why it is called as CAPM model, so you can able to understand here. So here we have to go for discussion about the here what is the CAPM. So main objectives behind that session is to understand the concept of CAPM theory, to distinguish between CML and SML. Also we have to take into consideration that is here to test the empirical test of CAPM. So the CAPM theory. First we have to go for discussion. CAPM theory means what actually? Mark Weiss, William Sharpe, John Lindner, and John Moshin provided the basic structure of the CAPM model. So it is known as John Lindner Moshin model also. So it is model of linear general equilibrium return. So the required rate of return of an asset is having a linear relationship with the asset's beta value, that is undiversifiable or systematic risk. Risk return trade-off. CAPM model means risk return trade-off, you have to remember. So there are the different assumptions we have to take into consideration. So what are the assumptions we are going to discuss? Number one, an individual seller or buyer cannot affect the price of a stock. Again next term, investors make their decisions only on the basis of their expected return, standard deviation and covariance of all the pairs of security. Investors are assumed to have homogeneous expectations during the decision making period. Investor can lend or borrow any amount of funds at the riskless rate of risk or interest. Assets are infinitely divisible. Again there is assumption there is no transaction cost, there is no personal income tax, unlimited quantum of short sales is allowed here. So you can able to understand here. That is here we have seen there is no transaction cost, there is no personal income tax, unlimited quantum of the that is here we can say short sales is allowed. So what is mean by lending or borrowing, we can able to discuss here. Already we have discussed in the class, but this is the revision type, so we are taking into consideration in short term. So it is assumed that the investor could borrow or lend any amount of money at riskless rate of interest. That is RP is equal to portfolio return, XF is equal to the proportion of funds invested in risk free asset, 1 minus XP is equal to the proportion of funds invested in risky asset. RAP is equal to risk free rate of return, and RM is equal to return on the market risk or market return we can say. So here we already discussed in our syllabus risk free RF, and here we can say RM is return of the market portfolio, and W1 is that is nothing but the weightage of the risk free asset, and W2 means what actually weightage of the market portfolio. That means here W and 1 minus W we can able to take, and with the help of that you can able to calculate the expected return on the combination of risk free and risk asset is equal to that is here RP is equal to RF XF plus RM in bracket 1 minus XF, or we can say RP is equal to W that is here we can say RF and plus RM 1 minus W, already we have discussed. So now next terminology we are going to discuss, that is nothing but market portfolio. Market portfolio means what actually, it comprised of all stocks in the markets. So each asset is held in the proportion to its market value to the total value of all the risky assets. So we can able to take, so capital market line we can able to observe here. So on y-axis that is risk is shown sigma p, on an x-axis we can able to get return of the portfolio risk free asset, and a line is drawn there, that is nothing but the capital market line. Efficient frontier is also drawn where the all possibilities are available. So capital market line, the portfolio along the path RFS is called a lending portfolio. That is here we can say here this is some money is invested in riskless asset, means risk free asset. So if it crosses the point S, it becomes borrowing portfolio. So money is borrowed and invested in the risky asset. So the straight line is called capital market line. So that represents linear relationship between the required rates of return for efficient portfolios and their standard deviation. So we can able to get idea. Again I will explain that chart, you can able to get idea. The portfolio along with the path RFS, this RFS is given. So it's called lending portfolio, that is some money is invested in the risk free asset or riskless asset. If it crosses the point S, it becomes borrowing, and money is borrowed and invested in the risk asset. So this straight line we have drawn, that is nothing but CML. So CML means what actually? A linear relationship between the required rates of return for the efficient portfolios and their standard deviation. You have to remember efficient portfolio where all feasible sets are available for making us investment decision. So capital market line is shown by the different formula. So E of RP or RP bar is equal to RA plus in bracket RM minus RF divided by sigma M into sigma P, where E of RP is equal to portfolio's expected rate of return, RM is equal to expected return on market portfolio, sigma M is equal to standard deviation of market portfolio, sigma P is equal to standard deviation of the portfolio. You have to remember that symbol because definitely that question will be asked for the examination. You have to make combination of risk free asset and risk asset. So RF means risk free and RM minus RF, that is slope of the line. If you go for calculation, sigma M means standard deviation of the market and sigma P is nothing but the, here we can say, standard deviation of the portfolio. So you have to remember. Next we are going to discuss return. The expected return of an efficient portfolio, that is given here. Expected return is equal to above formula we can put in that way, price of time plus price of risk into amount of risk. RM minus RF divided by sigma M, that is nothing but the price of risk. RF means price of time and sigma P is nothing but amount of risk. So here we can say price of time is nothing but the risk free rate of return and price of risk is the premium amount higher and the above risk free return. You can able to get idea. Next we are going to discuss security market line, that is nothing but the second point, or it is also known as CAPM. So capital market line does not show the risk return trade-off for other portfolios and individual securities. So standard deviation include the systematic risk as well as unsystematic risk. Unsystematic risk can be diversified, it is not related to the market. Systematic risk, it is related to market and it could be measured by the beta. So the beta analysis is useful for individual securities and portfolios, whether efficient or inefficient. So we can able to understand here. So security market line, the SML, which is helpful for determining the expected return for a given security beta. So here we can say RI minus RF is equal to RM minus RF divided by sigma M, covariance IM divided by sigma VM. You have to remember y is equal to A plus beta x, and with the help of that you have to remember. So now you can take that chart, you can able to get idea. So on y-axis that is return is shown, on x-axis beta, that is here you can say beta, that is risk is shown. So here 0 again risk free asset, again rate of return of the market portfolio, that is line is drawn here, that is nothing but the SML. So evaluation of the securities with SML, above the line and below the line. If above the line points we can say underprice and below the line we can say overprice, and if that is the on the line, that is we can say correctly priced. So we can able to get idea. So the stocks above the SML yield a higher returns for the same level of risk. They are underpriced compared to their beta value. So we can able to get idea. So with the help of that CAPM model, we can able to make pricing of the securities, whether it is correctly priced, overpriced, or that is we can say underpriced. So here we can able to get idea. So you can check the figure, you will get the idea. So RST, these are the 3 points are underpriced, ABC are correctly priced, X that is UVW, that is nothing but the overpriced. So the stocks above the SML yield a higher returns for the same level of risk and they are underpriced compared to their beta value. So RI already we have discussed historical return. D plus PE minus PV divided by PV. P means present value here, PE means ending value, and that is here purchasing value or division. We can able to get idea, we can put. So here there are the empirical tests also available. So you can able to get idea. Empirical test of the CAPM. The studies generally showed a significant positive relationship between the expected return and the systematic risk, but the slope of the relationship is usually less than that of the predicted by the CAPM. So risk return relationship appears to be linear, and empirical studies gives no evidence of significant curvature in the risk return relationship. So the ambiguity of the market portfolio is the CAPM untestable. So if the CAPM were completely valid, it should apply to all financial assets including bonds. So present validity of the CAPM. CAPM provides the basic concept which is truly a fundamental value. It is useful in the selection of securities and portfolio. So given the estimate of the risk-free rate, the beta of the firm stock and the required market rate of return, one can find out the expected return for a firm security. Now arbitrage is not in our syllabus, so only arbitrage we see concept. What is arbitrage? Arbitrage is a process of earning profit by taking advantages of differential pricing for the same asset, and this process generates riskless profit. In the security market, it is of selling security at a high price and the simultaneous purchase of the same security. So you have to remember that APT. So here simplest form of APT model is consistent with the simple form of the CAPM model. APT is more general and less restrictive than the CAPM. APT model takes into account of the impact of the numerous factors on the security, and the market portfolios is well defined conceptually in APT model. Factors are not well specified. There is lack of consistency in the measurement of the APT model. These influences of the factors are not independent of each other. So we have discussed through the chapter what is the concept of CAPM theory. Again we have discussed here, that is here nothing but that is how we can able to understand CAPM model. What are the various components? For example, VML and CML. That is we can able to get idea. So here we are going to discuss about the investment management problems. What